Just start with copper for a second. Do you get the read that that's a strong demand pull, why refiners have been working overtime, or is that just tighter mining production and that's sort of driving down that price?
Well, I think it's a combination of both. On one side, you definitely have a very resilient global economy. You're absolutely correct the way you described it. It's not just resilient, but the growth is broadening out, yes. Previously, it was just the service sectors that was driving the recovery in 2023, and it was U.S.-centric. Right now, we have a confirmation for 3 consecutive months that the PMI is actually recovering, and this recovery is broadening out from the services to the real economy, as you pointed out. This is manufacturing, this is industrial production. Not only that, we have signs that it's not just U.S.-driven. Europe is recovering as well, and China actually stable to slightly improving. So demand is actually very good across every single commodity under our coverage. But where you're correct, Alex, is that supply is underperforming as well. We had 2 very significant mine issues in December. It's the Cobra Panama in Panama, and then we had Anglo American downgrading their copper supply numbers out of Chile. And today, of course, we have the news with the Chinese smelters getting together and saying, as you pointed out, wait, we're not making enough money. Maybe we should start cutting production. It's about 300,000 metric tons of that. It's substantial, and if it starts piling up, that definitely makes a difference. So big rally today. Our target is $10,000, not in 2024. It's somewhere early 2025. But definitely we believe that the fundamentals are strong enough to support those levels.
So that's a clear way of saying it's a supply and a demand story. Like, we're firing
100%.
on a lot of cylinders with commodities. And if you think about it, if I were to tell you that commodities really outperformed so far this year when we're entering a world of, say, Fed and central bank cuts, I don't know if I would have believed you, and yet here we are.
Here we are. So commodities were a very big deflationary story in 2023. So if you look at the US CPI peaked at 9.1 in June 2022, yes? Last year, December, we closed at 3.4. So 2/3 of that deflation in the US headline CPI was driven by commodities. The biggest chunk out of that was oil price, yes, going down from $130 to about $75. But, you know, big deflation in the food prices as well. So this year, commodities are not going to be a deflationary force anymore. Best case scenario, it will be neutral. Worst case scenario, actually, they will be inflationary.
Yeah, we've already seen some pretty interesting gains, and even in the soft commodities. Let's talk about gold for a second, because that's been on a tear as well. And that there does seem to have a direct correlation to what we're seeing with the Fed and interest rates. Yes,
that's so we upgraded gold to a buy in December 2022. That it is our #1 trade recommendation for 2 consecutive years. Our target is 2,300. Monday, we hit a record level of 2,200. We believe that we can, 2,500 is a possibility because the market tends to get overexcited. For that, we need a confirmation from, continued moderation in the inflation and in the jobs numbers as well, and the confirmations that Fed indeed is cutting. So, but overall, yes, we think there is more to go.
All right, let's talk about oil, because there have been some interesting moves in that space. I don't know, it felt like a while ago we were all, wringing our hands saying oil was going back up to $100, and then it just kind of petered out, and it's kind of been doing nothing until recently.
It's up 15%. I know don't say that.
Yeah, I mean, we're up 10% on Brent or WTI or whatever it is these days here. But what's driving that? Is that real?
It is real. Yes,
yeah.
It is real. Yeah. So actually, oil is trading today exactly what it's supposed to be. The fair value is $83 in March. So it's actually doing exactly what it's supposed to do. The demand is good. Okay. Demand is really, really good. It's really resilient. People are flying. People are driving. We can absolutely see that demand is very supportive for that. So to us, the target is high 80s by May. We again see a very strong possibility that actually the market will overshoot. We can, see 90 May, June. And then, of course, what happened last weekend in OPEC and surprise announcement from Russia that they're cutting production. The market seems to be doubting. Then our view is that actually it's credible, that they want to see their production declining to 9 million barrels per day by June.
What would a breakout look like? And what would be a trigger for that?
So it would be similarly to what happened in September or August, September of last year. It would be inventories. So the market will wake up one day and the inventories are drawing down, and everybody will start saying the market is very tight, and then you'll see.
Is the breakup like 90? Like, is it
$10 higher? It's always 73, 83, 93, 93. So it usually moves in $10 increments.